Accounting concepts and principles. Accounting concepts. Now, these are the fundamental ideas, assumptions, and statements of accounting theory that provide a framework for financial accounting. These concepts are designed to ensure that financial statements will be prepared in a consistent manner. When this happens, it will be easier to compare different businesses' performance as well as position over time. Here are some of the accounting concepts. The first concept I'll look at is the going concern concept. Now, according to the going concern concept, a business will continue to operate for the foreseeable future and it will not be liquidated. So the business is going to be in operation with no intention of liquidating. That is according to the going concern. It's an assumption. Now, when we are preparing financial statements, we prepare them on the basis of the going concern assumption, meaning that the assets and liabilities are always valued and reported accordingly. For example, if a company is expected to continue operating, its long-term assets are not written off. Why? Because we are assuming that the company is continuing to operate. Therefore, what we have to do, we depreciate these assets over their useful life. That is going concern. That is one of the applications of the going concern. We use it normally when it comes to the valuation of assets. That we value assets on assumption that the entity is a going concern. We depreciate these assets over their useful life, so we don't write them off at the end of the financial year. The other key concept is the accrual concept. Now, according to the accrual concept, it states that revenues and expenses should always be recognized when they are earned or incurred. Revenues are earned, expenses are incurred. So we should not wait when cash is received or paid. Now, what is the impact of this accrual concept when preparing financial statements? This will lead to recording of what we call accruals or deferrals. What are accruals and what are deferrals? Accruals can be expenses or revenues that have been incurred or earned but not yet paid or received in cash. For example, accrued salaries, accrued interest income. The accrued salary has been incurred but not yet paid for. The interest income has been earned, but we have not yet received the cash for it. So these are referred to as accruals. Then deferrals. These can be expenses or revenues that have been paid or received in cash, but not yet earned or incurred. For example, prepaid rent. It means that we have paid rent in advance. And revenue. Revenue has been received, but it has not yet been earned. When we are preparing financial statements, the going concern assumption or concept and the accrual concept are very vital when it comes to the preparation of financial statements. Prudence. This concept or principle requires that accountants should be cautious when making judgments and estimates. In other words, accountants should choose the accounting treatment that is least likely to overstate assets or incomes. So you should not overstate assets or incomes. You should avoid those accounting treatments that over-exaggerate the assets or the incomes of the company. However, prudence can lead to conservative reporting, where potential losses are recognized sooner than the potential gains. So if there is a potential gain and a potential loss, according to the prudence concept, we should recognize the potential loss as soon as possible. For example, if there is uncertainty about the recoverability of a receivable, uncertainty, there is doubt, it might be written off, even if it's not yet proven to be bad. So whenever you see that we are creating a provision for receivables, provision for doubtful debts, we are doing so simply because of the prudence concept. Consistency as another accounting concept. Once an accounting method has been adopted, it should be applied consistently from one accounting period to the next. This helps to ensure comparability of financial statements over time. Remember, one of the enhancing qualitative characteristics of useful financial information is comparability. So consistency ensures comparability of financial statements over time. When it comes to changes in these accounting methods or practices, a change can be made, but changes are only allowed only if they result in a more reliable or relevant representation of financial statements. Of course, when a change is made, its impact on the financial statements should be disclosed. Materiality concept. The concept or the principle that states that only information that is significant enough to influence the decisions of users of financial statements should be disclosed. Any information that is insignificant can be omitted, or we can aggregate that information for it to be material. Materiality is a judgmental concept, and the determination of what is material depends on the circumstances of the entity and the nature of the information. A small error in inventory, a small error, something that is small, might not be material enough, but a larger error in revenue would be. So materiality will depend on the circumstances of the entity and the nature of the information. Remember, materiality is very key when it comes to identifying what information is relevant. Substance over form. The principle that requires that the economic reality of transactions should be reflected in the financial statements rather than just the legal form. So we should always consider the economic substance, the economic reality of the transaction over its legal form. This principle can lead to the restatement of financial statements if the legal form does not reflect the economic substance of the transaction. Remember, substance over form is very key when it comes to identifying whether the information is faithfully represented. A simple example here. If there is a sale of goods agreement, but in the agreement there is a clause to repurchase them later, you're purchasing goods, but in the agreement you have made, there is a clause that you are to repurchase these goods later. When you try to look at the substance of this transaction, this should be treated as a secured loan rather than a sale. That I'm getting money from the buyer, but I'm using my goods as security for me to be able to get the money. So the economic substance of this transaction is a loan. But of course, sometimes you'll find that you sell your goods with no agreement of repurchasing those goods. Then the economic substance of such a transaction is a sale. But where we see that the seller can repurchase the goods from the buyer, then the economic substance of that transaction is a loan. So that is the substance over form. We should consider the economic reality of the transactions, and that is what we should reflect in the financial statements rather than just their legal form. The entity concept. This concept states that the business entity is separate, legal, and economic unit from its owners. The personal assets and liabilities of the owners should not be included in the financial statements of the business. So we treat the business separate from its owners according to the entity concept. This is a fundamental principle to the preparation of accurate financial statements. It ensures that the financial information of the business is presented separately from the financial statements of its owners. Lastly, I'll talk about the money measurement concept. The principle that requires that only transactions that can be measured in terms of money should be reflected or recorded in the financial statements. This principle limits the scope of financial accounting to transactions that can be quantified in money terms. Non-monetary items such as the value of employee morale, customer goodwill are not typically recognized in the financial statements of a company. And that's it. We have covered the accounting concepts. Don't forget to like, don't forget to subscribe to my YouTube channel, and hit the notification bell for more content. Thanks for watching. I remain your accounting tutor, Senior Hannington.